In this video, we're going to touch on the problem with indicators and what to do about it. Have you ever played the game telephone where you pass on a phrase to the next person? They whisper, "A big cat was hunting a tiny mouse." And by the time it gets to the end, it becomes "a black cat was hiding from a tan moose." That's the confusing nature of using indicators. My wife calls me a hoarder, and she's probably right. One thing I keep is a bag full of receipts. I can tell you how much I spent at the grocery store 5 years ago. Now, what if I take a receipt, get a pen, doodle all over it, spill some coffee on it, crumple it up, and leave it in the sun for a week? All the prices are still there, but how much harder is it going to be to read them? A trading chart is the historical record of the prices people bought and sold at. So why do we think it's a good idea to add so many indicators to it? Go back to high school math. We have the X and Y axis. The X is the independent variable and the Y is the dependent. Think about the connection between the temperature outside and ice cream sales. As the weather gets hotter, more people want to buy ice cream. The connection is obvious, and yet when it comes to trading, many completely ignore what's on the X and the Y axis. Here's your typical chart, and what do you notice on the X axis? It's time. And what about the Y axis? Price. It took me a long time to realize that time is what affects and drives price. A Monday is not the same as a Wednesday, and 9 a.m. is a totally different market than 9 p.m. When I was a losing or break-even trader, this is how I used to think. I'm going to put a moving average on my chart. When it goes above, I'll buy. And when it goes below, I'll sell. In a long-term trend, sure, that'll work fine. But what about here? Buy above, flip short, and keep getting whipsawed and eaten up by losses and commission. Soon after this, I realized maybe a moving average isn't enough. I need something to smooth out the moving average. This is when I stumbled on momentum indicators. Here I'd only be looking to take trades when the two agree. In this case, a long signal. The biggest downside of most indicators is how much they lag. We're still getting long signals when we'd rather be short. The momentum indicator finally switches to red and we're taking shorts as price starts to go back up again. If we treated our everyday life like we did our trading, we'd probably see how foolish we can be sometimes. Let's say we're in the car and every 60 seconds for the next 2 hours, we make a note of how fast we're going. Looking at the graph, it's pretty easy to piece together a likely story of what happened. At 10:15, we're in the parking lot. Get up to 50 miles per hour, slow down to 30 going through a corner, speed back up to 40, and then we come to a stop sign or red light. We do more city driving until we get on the highway, hit a max speed of 75 miles per hour, slow down to 70, and then we set our cruise control for the next 30 minutes. Something causes us to temporarily slow down, get back up to 70, and then we set our cruise control again until we exit the freeway. Sit at a red light for a couple minutes, more city streets, and then we finally park the car. At every point in time, we know exactly how fast we're going. Putting a moving average on the chart is kind of useless. At the beginning and the end, speed is either way above or way below the average. And of course, a moving average does lag behind. Here we set our cruise control to 70 miles per hour, but the EMA didn't catch up until much later. If you remember from physics, acceleration is looking at the change in velocity over time. These flat spots are where our cruise was set to 70. Speed was constant, and since we're not speeding up or slowing down, acceleration is 0. Thing you have to realize about indicators is the more you manipulate time and price, the more information you lose. Going back to where acceleration was 0, cruise control could have been set to 50 or 70. The graph would look exactly the same. I do see the appeal of indicators. The charts can be ambiguous. This is a way to cut through the noise. Wait for 2 lines across, or you see an arrow paint on the screen. It's like someone tapping you on the shoulder and telling you now is the time to enter. ICT and others stress the importance of stripping everything away and focusing on time as it relates to price. We're told time is important, but the problem has always been lack of resources. If I asked you, is the high of the week most likely to be on a Monday, Tuesday, or Wednesday, would you know the answer? And if you wanted to find out, where would you go? It's not really feasible to keep track of every candle going back years. And not just the day of the week, but knowing the time of day when price is most likely to make a high or low could be worth its weight in gold. The good news is I recently came across a site called Edgeful that'll help you answer all of these questions and more. I'll leave a link to their website in the description below. Now, let's take a look behind the curtain. No matter what you trade, this is going to be helpful for you. First tab is stocks, and the default is SPY, but you can scroll up to Apple or whatever else you want to see. I've recently been looking at futures more. We have ES, NQ, YM, and a bunch of others. Moving over to forex, you'll see every major pair and cross you'd ever want. They have 4 report types. Today we're going to look at price action. First report we're looking at is the gap fill. We're on NQ, the New York session, in the last 1 year of data. If you scroll down, each report has a video explaining what those specific stats are. As the name suggests, a gap is when the close and the following open are at different prices. Here we close lower and open higher, so this would be a gap up. We want to know how often price will go down and touch yesterday's close by the end of the day. So on the left we have gap up, and then on the right we have gap down. 100% of the time we had a gap down it filled, and most of the time a small gap up ends up getting filled. As the gap gets bigger, it's less likely it gets filled. And for a gap of 1 to 1.5%, it almost never gets filled. If you see the market gap at the open, you can use this report to set a likely take profit or put your stop loss in a safer spot. You can also look at how often gaps fill based on the day of the week. Think about the market closing on Friday and then opening lower on Monday. The first day of the week is more likely to be a fake move, and 83% of the time, these gap downs fill in. But look how big of a difference a day makes when we click on Tuesday. We go from over 80% to below 50% getting filled. Another valuable thing to know is the day of the week when the highs and lows are most likely to form. A lot of people don't like to trade Monday or Fridays for some reason, but looking at Euro NZD over the last year, these 2 days are statistically speaking the days you want to enter and exit. Tuesdays and Thursdays are usually just reversals or continuations, and not the start or the end of the move. All of this data is for the last 12 months. Let's see if anything changes going back 5 years. A larger time frame gives us even more confirmation that we want to be active on Mondays and Fridays. As a side note, I want to compliment Edgeful for how they classify time. You can tell they're actual traders. Most people would have the daily candle going from 12 a.m. to 11:59 p.m., but they recognize the day ends with a New York session at 5 p.m. What's more, they even break the daily candle into the 4 sessions: Sydney, Tokyo, London, and New York. Maybe you only trade the London session. Clicking on it, you can see the stats filtered for only what's relevant to you. We know that time and price is fractal, so instead of just looking at a session or a day, what would happen if we look at a monthly candle? For the last 5 years, we can see AU starts the year down. Spring and summer is a mixed bag, and then we see an uptick towards the end of the year. Switching to the weekly view, we get even more detail. Scrolling down, you can see every single December was bullish for the last 5 years, but 4 out of 5 Januaries went back down. If you're a swing trader, enjoy the holiday trend, but maybe you want to close your trade out by the end of the year. If you're more of a day trader, you can use this information to form a bias or look for a reversal. The next report can help you make money on days when FOMC comes out. Obviously, I'd recommend closing all your trades before 2 p.m. and letting the market settle down for about 15 minutes. But if you have the right information, you can take advantage of it and make money for the remaining 2.5 hours. FOMC comes out at 2 p.m. New York time, and we know the beginning of the day usually chops around waiting for the news. The news either spikes up or down, and we want to know what price is most likely to do for the remainder of the day. We're looking at EU over the last 5 years, and only FOMC days are included. We see when price jumps up at 2 p.m., the next 2 15-minute candles are also likely to be higher. And look at the 2:30 candle. Oftentimes the market will tip its hand and you can catch another massive move. When this happens, you want to take your profit by 245 because the rest of the day is most likely to reverse. If you're a scalper, you can wait for that second push and then look for a reversal signal. This is the chart when we have a positive reaction. Now let's switch to when the news is negative. If you notice, this graph looks nothing like the one we just saw. Before, we saw strong, immediate continuation. When there's negative news, you want to take the completely opposite strategy. The market will take a 15-minute break to get its bearings, and then instead of continuing like we saw before, it violently reverses, on average twice as much as the actual news. FOMC moves can be huge, and using the Edgeful website for the specific pairs you trade, even if you only catch a few of these moves a year, you can make a lot of money. These positive and negative charts are the average of all events. You also have the ability to go back in time and look at a specific date. We click on individual days and let's look at 320, which is the most recent one. Here we see the same pattern. It was a positive reaction, so we expect the falling candles to be a continuation. When we see a red candle, we know there's likely to be a second push up, which does in fact happen. We're on March 20th, and this is the last candle before FOMC. Right before the news comes out, are we trying to predict what it's going to do? No, not in a million years. We're not here to gamble. We're gonna wait for 15 minutes after the news. We saw from the data when there's a positive reaction, the market is likely to continue higher for the next few candles. Maybe you want to go for the low-hanging fruit. You market buy and target the data highs for 1.5 to 1. Or it's reasonable to target the recent highs for 2.5 to 1. We just looked at the FOMC performance. Now let's see what we can learn from the intraday timing. If you've ever heard people refer to ICT's silver bullet, this is an entry model between 10 and 11 a.m. in New York time. I find it interesting when an independent source says the exact same thing. For the entire 9-hour New York session, there's a 10-minute window between 10:57 and 11:06 when the high or the low is most likely to form. The silver bullet is a reversal strategy, and given the right setup, our entry or exit can be at the extreme of the day. Intraday timing will tell us when the extreme is most likely to be. We can also look at how far price can move by clicking on the intraday range window. If you're looking at the charts from 9 to 11:30, you can expect about 38 pips of movement. After lunch, volatility settles down and we can only expect about half of this move at 19 pips. If you only trade certain hours of the day, this can help you set reasonable take profit and stop losses. When talking about time, certain sessions are more likely to be continuation and others will be the fake outs. Let's look at the outside days report. A bullish outside day is when price opens above yesterday's high, and a bearish outside day is when price opens below yesterday's low. For the Tokyo session, 2 out of every 3 times when this happens is likely to be a continuation. Price opens higher and you can look to go long. Price opens below and you should have a short bias. Compare that to the London session. 3 out of 4 times, the London Open is a misdirection, and you should have the opposite bias. This is another example. Without Edgeful, I never would have known this, but now I can implement it into my trading. We can look at the numbers from a different angle with the initial balance breakout report. Initial balance is set by the high and the low of the first 1-hour candle of the session. We want to know what price is most likely to do for the rest of the session. We saw before that many of the fake outs happen in London. 2/3 of the time, price will break one side of the candle and then turn around and break the other extreme of the range. Compare this with the New York session. The exact opposite happens. We set the New York range from 8 to 9 a.m. Once price breaks the high or the low, 2 out of every 3 times it will continue, and the other end will never be hit for the rest of the session. We're on EU, and here's the 2 a.m. candle. The range is the high and the low. Next candle breaks the low, but we should probably have a long bias. 2/3 of the time we'll come back and hit the high. Now let's look at the same day, except using the New York range, which is from 8 to 9 a.m. Here's the 8 a.m. candle and we can adjust the range. At this point, we want to wait, see if the high or the low is broken. We just saw that 2/3 of the time this low will not be hidden. So depending on your money management, you could use this as your stop loss for the rest of the session. This is only a taste of what Edgeful is capable of. And remember, you can run all of these reports on ES, NASDAQ, whatever stock or forex pair you want. We started this video mentioning indicators are lagging. They only tell you what price has done in the past. Time is what really affects price. But as we've seen, not all times are equal. Some times of the day are more likely to be a smart money trap, and others will be the true continuation. With this information, you can even learn to make money from FOMC instead of blowing up your accounts like most traders. Think about understanding the connection of time on so many different levels. Various months are historically better or worse for a pair. Zooming in, certain days of the week are more likely to make the high or the low. Breaking a day into 4 sessions, we can start to see the characteristics of London versus New York. The Edgeful site is so sophisticated, you can drag the time bar to only the times you trade, and it'll tell you how far price is expected to move. Other reports will have you key in on the first 15 or 60 minutes of a session and tell you what price is likely to do over the next few hours. I'll leave a link in the description below. And speaking of time, I recently released a video that focuses on the price action, specifically at 7 a.m. to look for trade setups. Click here to check it out. Thanks for watching. Talk to you soon.